All right, so let's talk about this private credit crisis. And you know, one of the things that I've been thinking about as we've been talking about volatility and the New World Order and all that stuff and the bubble bursting and all these things, there's gonna be a one trigger event that will divide the old from the new. That's just how I see things. And I've been trying to figure out what is it going to be. I knew it was going to be a crisis, and I've been trying to figure out what it's going to be. What is this change of the guard going to be marked by? And I think it's going to be private credit.
Okay.
All right, so first of all, let's talk about what private credit is.
You're going to have to walk me through that one.
I know. Well, I think it'll be fairly evident by the end of this episode. Okay, so what is private credit? All right, y'all, you already know the deal. More than any episode, especially this episode, this is for entertainment and information purposes only. This is not investment advice. I'm not a financial advisor. I'm not your financial advisor. So make sure that you proceed with caution, do your own research, do your own due diligence. Every investment takes on a risk of loss of your money. You can lose your money. Keep that in mind. This is not financial advice. So with that being said, enjoy. So, a couple episodes ago, I touched a little bit on the private credit crisis, and everybody in the comments was like, talk about the private credit crisis. And then the next episode, before the next episode of the show, we went to war. So I had to not talk about the private credit crisis because I needed to talk about the war because everybody's panicking and it just is what it is. And I'm glad that we waited, because I've been following this private credit crisis for a nice little minute. I'm gonna tell you why in just a minute. But now it's made the headlines because BlackRock has limited redemptions to their private credit fund. And so now everybody's talking about it, but your girl been following it for a minute. I'm gonna tell y'all about that in a minute. Before we go in, I do wanna do like a quick apology, little note. I forgot to tell you about this. Shout out to y'all. Y'all is doing your girl big one with watching this show and liking it and commenting. I love this community that we're creating. Asterisk, you know, always you focus on the negative comments, okay? But let me just be clear. Y'all making your girl feel really, really good. Two people commented and said that I said that war is not bad. And I'm not going to go and watch the episode again. I'm just not going to do that. And it may have been a soundbite, and I want to apologize to all of humankind and to God if it made it seem like I think that war is not bad. I want to apologize to everybody, okay? If I said that, sometimes I say the wrong things. But what I do want to say is war is absolutely bad, but I want to tell y'all that humans, especially in American culture, have killed more people in times of peace than in times of war. What am I talking about? I want to make sure we're talking about private credit crisis, but I want you to open your eyes to the fact that they're killing you in your food, they're killing you in the air, they're killing you with the water, and y'all let it go. And these people are supposed to be your allies. So I'm not saying, hey, focus on this and don't focus on war. War is bad. But what I'm saying is if you're going to be enraged, you really need to be enraged by what they are doing to you through the medicine, through all the things that y'all all know. It's plastic everywhere.
Yeah.
Plastic causing cancer. They got a cure for cancer, they won't give it to y'all. Okay?
I think when you were speaking on that, on war, and that particular essence of when you did mention it, you weren't speaking on it from a morality standpoint, though. I think you were speaking on it from the aspect of what it does to the economy.
And yes, you know what I meant. 99.9% of y'all know what I want. How do I know that's the percentage? Because that's the percentage of people that liked the video versus the people that didn't.
Right.
So I know y'all know your girl's heart, especially those of you who have been watching my Bible studies and all that. I ain't perfect. None of us is. But I want to apologize if I just verbally said a sentence that did not reflect how I feel.
Right.
Okay? And we're all going to pray for them babies that was killed in Iran. And anybody who is negatively affected for this. If you need to, pause. I've been praying. I know Brandon been praying. Pause this, say a prayer real quick. I'm commanding you, pause and say a prayer real quick and come back. Okay. All right, so let's talk about this private credit crisis that Fam, you know, one of the things that I've been thinking about as we've been talking about volatility and the New World Order and all that stuff and the bubble bursting and all these things, there is going to be one trigger event. So this has been in the back of my mind. There's going to be a one trigger event that will divide the old from the new. That's just how I see things. And I've been trying to figure out what is it going to be. I knew it was going to be a crisis. And I've been trying to figure out what it's going to be. What is this change of the guard going to be marked by? And I think it's going to be private credit.
Okay.
Okay. All right. So first of all, let's talk about what private credit is.
You're going to have to walk me through that one day.
I know. Well, I think it'll be fairly evident by the end of this episode. Okay. So private credit, what is private credit? Private credit is a loan that's not done by a bank. Period, point blank. There are a number of ways that this can be done. It can be done, they have funds that are called business development corporations or something like that, where private credit loans are done, but they're traded on an exchange. So even though it's private credit, it's exchange traded, but then they also have funds that are done in private with accredited investors, your sovereign wealth funds, all those things. Okay. All right. So you may be thinking, before we even go into all of that, you may be thinking, what types of loans? So these are commercial real estate loans. Y'all know we're talking about real estate, commercial real estate loans, business loans, leveraged buyouts.
Okay.
This last one, this is probably a whole bunch of things, but I will focus on these 4 things. Probably going to mostly talk about 2 of them. But this last one, this is where the problem is going to be. Insurance. Okay? So here's the thing. This is how I want you all to look at this private credit crisis. This is how, because remember that episode when my hair was sticking up and Brandon left? When he came back after being gone for a month, and he let my hair stick up.
Right after that, though. I got
you did.
Right.
You get me right after that. One time, my lip was doing a thing. My lip gloss was doing. He was like, "Fix your lip gloss." Okay.
The hair is good.
Thank you.
The hair is good.
Thank you. This is how I want y'all to look at this private credit crisis. Mark my words, okay? Pay attention to me. So remember in 2008 where we had the real estate housing collapse, right? And 99% of people didn't even know that it was looming until after it was collapsed, okay? Most of y'all are young. I was working on the street at the time, okay? I actually was trading that day and it was crazy. I'll never forget it. But talk about it another time. Even me being on the street, I was so young. I just didn't know that what was about to happen was about to happen. But then once the layers got peeled back off of it, we saw that the signs were looming. It was just everything pointed to what happened in 2008. What I want you to look at is, because you got me, this crisis something will happen, it'll be a trigger event. You're this time on the pre-side of the trigger.
Right.
Because we having this conversation.
Right.
We're on the pre-side. So this is a once-in-a-lifetime opportunity. Now, everybody gets to see it coming the way that you guys are going to see it coming, okay? All right. So let's talk about what just brought this out. BlackRock. BlackRock limit redemptions, all right? They have a $26 billion fund and they had $1.2 billion in redemptions. And they're only honoring about half of it, $600 million. That's a lot of redemptions. Okay, why is all these people requesting these redemptions? All right, we got to back up a little bit. A little while ago, another company, much smaller company called Blue Owl, they had a bunch of redemptions and they had a huge crisis. This was not even that long ago. It was like maybe, I don't know, a month ago. Blue Owl, they had 2 funds. One is a BDC and one is a publicly traded BDC and one is a private BDC, okay? What is a BDC? The government allows companies to set up these private credit corporations that lend private credit as long as they pay 90% of their dividends out to their investors. They can't they can't retain their dividends for some major tax benefits, okay? Now, to go even more in depth, we have a newsletter where I break down structurally interesting things that really move the market. I give you my frameworks for how I think specifically about business, because you need to understand business to understand this stuff. Also, too, y'all know I have partners for our private equity fund, and they contribute to the newsletter too. They know their stuff with apartment investing. Noelle Parnell and Arthur Lyons. Get on the newsletter. The link will be down below. It is 100% free. What is a BDC? The government allows companies to set up these private credit corporations that lend private credit as long as they pay 90% of their dividends out to their investors. They can't they can't retain their dividends for some major tax benefits, okay? So this incentivizes these corporations to set up these vehicles to be able to provide credit to people, but they have to pay out 90% of their dividends. They cannot retain their dividends, okay, in order to get these tax benefits. So one of them is publicly traded, which is great because if you're an investor in that, it's traded on the public markets. You can buy and sell. Liquidity. Awesome. Boom, boom, boom. The second one is private, okay? That one is very much so less liquid because if someone needs their money back, they either need to sell the assets in the fund or they need to sell the shares to someone else. All right. So you had a lot of people in the private one selling their assets within the fund. I'm assuming to provide liquidity because gold, Bitcoin, war, and rumors of war, all the things, right? So they want liquidity. So what does this mean? This means that Blue Owl needs to sell their assets. Most likely, they probably can't sell the shares to someone else because it's super illiquid. They need to sell the assets within the fund. What are the assets? The assets are the loans. Okay, so they're going to their friends saying, hey, you want to buy these loans? Coming to find out, the loans, the value of the loans aren't what is being put on, is not what's on the books because people are defaulting on loans.
So Blue Owl, right, essentially is what type of, because from my understanding, fun fact, I actually had been looking at Blue Owl since 2021. So I was invested in Blue Owl in 2021 for a brief period of time. Not long, probably like 6 months. But they've been on my watch list since 2021.
Okay.
So I've been watching Blue Owl, and since 2021, it did like skyrocket. But now it is falling back down to those 2021 lows.
Yeah, because of this whole crisis.
Now, I thought it was a mutual fund. Is it not a mutual fund?
It's a family of funds. Right, so you're investing in the company. If you're investing in Blue Owl itself, if they are publicly traded, I'm not even sure if they're publicly traded or not. I'm assuming that they are, right? You're investing in the company that is the family of funds.
Okay.
Right? So you're not directly investing in these private credit assets.
Okay.
Okay? You're investing in the company. They may have they apparently they went from like 0 to 300, I don't want to say 300 billion. Look at, say, Blue Owl assets under management.
300 billion.
And so it's a couple companies that's big on the private credit space. It's Blue Owl, Ares, and Apollo, okay? So they're not as big. Blue Owl is not as big of a fund as BlackRock, which we'll get to in a minute. But this is a big part of their whole world. Anyways, I got more to share, and then y'all gonna be as surprised as me. All right, so this company, they have a private and a public BDC, right? Let me just also back up. Some time ago, they were trying to merge the private and the public BDC, probably because they saw that redemption requests were going to be a problem, and the private and the public BDC will allow for the liquidity. hey, you can just sell your shares on an open market instantly. We don't got to actually sell the assets in this portfolio, exposing the NAV. And apparently what ended up happening was when they went to go do the merger, the reason why the merger didn't happen is because it got exposed that the NAV, the value of one of the loans that was in, I think the public one, was 80 cents on a dollar. Versus 100, which is what they thought it was. So of course these investors over here in the private one, they don't want to merge with the public one, and y'all misvaluing the loans. Crazy, right? Which kind of brings me to the point about valuation versus price and all that stuff. Y'all know my issue with the public markets and when things are valued based off of what people just say the value is versus not valuing it based on either the income or revenue or rents or whatever the case may be. These loans should be valued based on the payments. When you just start making up values, it's not value based, it's value based on whatever the trade is, especially in the private markets, the private credit markets. A lot of these transactions, when this loan gets sold to this person, a lot of this stuff is done without transparency. Okay? I'm going to take an aside real quick. Talk about transparency. I've been itching to talk about this because this is the part that no one is really paying attention to that y'all going to be able to take advantage of. Okay. Insurance companies.
Right.
So you know I got a whole theory about insurance companies. We're not going to talk about insurance companies right now. We're not going to talk about my theory about it because I'm scared they're going to come and get me because I have a whole entire theory about insurance companies. But that's just later groundwork. Insurance companies are some of the oldest companies in the world.
Right.
Okay. Let me do a real quick aside. One of the things about this private credit crisis, why it won't initially make the headlines, is because it's always going to be compared to the crisis of 2008.
Right.
And part of that was bank loans.
Defaulting.
Right. These private credit loans is not done by banks. So it's like, hey, this isn't going to cause a banking crisis. So this is in 2008. It's going to be isolated. Okay? Keep that in mind. All right.
So let me ask you real quick before you go too far. These private credit loans are done by these.
They're done directly. Hey, a lot of times, what I want you to think about like this. Hey, I want to do a buyout. I'm a private equity company. I want to do a buyout of this company. We're going to raise some equity. I need to get some loans. You're not going to go to a bank. I'm going to go to you, right? You are a private credit lender. You've raised money. You started a fund. Hey, loan me the money.
So essentially, it's the people.
Like, what do you mean by the people?
So when you go to a bank, you get money from the bank, and you get a loan from the bank, right? But when you do it from a private equity standpoint,
you do it from the investors. The money comes from the investors, right?
And the investors are the people, though. And when I say the people, like whoever your investors are, your community.
But there's usually larger investors, accredited investors, sovereign wealth funds. They're very sophisticated. They're supposed to be able to understand what's going on and know, understand what they're investing in. But the reality is, we're going to come back to this in a minute. I probably should have outlined this. What causes a crisis, which is people don't understand, willful ignorance about what they're investing in. Okay.
What I thought you were going to respond with was when we talked about the real world versus that.
Simmer down, because I'm already forgetting what I'm about to say.
All right.
Dang nabbit. Okay. We can come back there in a minute. It's so much here. It probably should be a 2-part episode. Okay. Banks. It's supposed to be separate. It's private credit market, banks, separate. Okay. Insurance companies. Insurance companies, oldest companies in the world. 150 years old, all the things. All right? They've gotten really, really good at being able to predict when people are going to die. All right? About 30 years ago, before insurance companies used to be nonprofit organizations, like funded by nonprofit organizations.
Right.
About 30 years ago, private equity started coming into the space, and that changed the game. Insurance companies used to invest very conservatively. Once private equity came into the space, then they started investing way more riskier. And also the regulation got super lax, like overly lax. Insurance companies are regulated on a state level, and apparently these regulators on a state level, they are super uninformed, okay? Hang on to my every word. They are just not as sophisticated as the actual insurance companies. So when they go and they do their investigation, their audits, they're not even fully understanding what's going on. In addition, there are about 5 states that insurance companies love to basically rest their head in, because these 5 states allow for what's called permitted practices. Okay? These permitted practices allow them to not have a lot of transparency around what assets they use to back your insurance premiums. Okay?
Okay.
So what these companies can do, it's wild. And let me just be very, very clear, because it's not public and it's a lot of lack of transparency. This is all a little birdie told me. So don't take this to the bank. So apparently what these insurance companies do is they set up special purpose vehicles, SPVs, other companies, wholly owned subsidiary companies, that they call it captive reinsurance. So let me also back up. The insurance company is owned by the private equity company. The private equity company will set up these captive reinsurance companies to then take on some of the premiums, back it by assets that aren't necessarily a match to the premiums. So birdies whispering in my ear have said that some of these are like, the payout is worth $5 billion. The assets underlying them are only worth like $2 billion. Okay? And so in order to make up the gap, they're making private credit loans to each other. These is wholly owned subsidiaries of the private equity.
Now, which makes me think about what
Go ahead.
Oh, what were you
No,
about to say?
I don't want to get too much into the complexity of this, because we got to come back out. I needed you to just understand what's happening,
Okay.
so we can understand what's happening in the private credit markets. Okay?
Okay.
Which comes to the point that the road that you were trying to get me to go down, because hopefully you guys have been picking up what I've been putting down on all of these episodes, is that you being in the real world, you understand more about the markets than some of these Ivy League quants. Okay? Because what marks a crisis is the divide between what's happening in the public markets, up in the ivory tower, not just in the public markets, private, in the ivory tower, in private equity. A disconnect between that and what's happening in the real world. So now we're seeing private credit freeze up because people are defaulting on loans, and there is not transparency behind what's being packaged, and people are taking more of a risk than what they should be taking for certain assets. Okay? This is happening because people are defaulting, really, at the end of the day. Had they just looked, people started defaulting and having issues going all the way back to 2023, 2024. Now, I've been saying this for a while, okay? And people act like I don't know what I'm talking about, but it's because I can open my eyes, right? I think sometimes, especially with Black people or people who are underprivileged or underserved, you're so used to poverty, you can't notice when poverty gets real poverty. Like people that's normally winning ain't winning.
Yeah.
Or things so you're just so used to, but you gotta like really take a step back. I said this, I made a post. I talked about this. 2024 is the worst year of my life, financially, of my life. And I did a post where I was like, hey, y'all, I'm not having fun. I don't want no sympathy. I got people that love me. I'm good. But I'm just letting y'all know, when I post when I'm up, I also got to post when I'm down. Like, I don't want y'all thinking that I'm out here fronting, and I don't care. Like, I'll tell y'all when I'm down. When I tell y'all, so many people came out the woodworks, people that y'all follow, that's known for making a whole bunch of money, all the things. I don't know if y'all saw Pinky Cole, she filed bankruptcy, Uncle Nearest is having issues, all the people that's flying high. And I'm not knocking them, because this is what happens. But what I'm saying is, we knew this was happening. The same way they was making them loans, them bad loans, underwriting loans for more than what the property value is worth in 2008. Had anybody, and y'all are up here in your ivory tower, and all the dude that from The Big Short that called it, all he did was go and knock on doors.
Yeah, Michael Burry. Yeah, going door to door.
He just went and knock on doors. What's really happening?
Yeah.
Went to a couple houses. Oh, ain't nobody here. Oh, this grass ain't been cut in weeks. And this got a loan at 110% of the value.
Yep.
So you know what's going on. These ivory tower peeps, they're not smarter than you. See it in the real world, because what they're underwriting at the end of the day, they can be underwriting all these sophisticated products, but at the end of the day, they're underwriting your behavior. Just like insurance company, oldest company in the world. Guess what is underwriting? Your lifespan.
Yeah.
They can make all this stuff in between that's complicated, but they need to know how long you're going to live. This is the thing that I almost forgot to say. I did that whole conversation about banks and why this credit crisis is different than before, because it's not accessing the banks. Guess what banks invest in?
Bonds.
Insurance. So they're not going to be, like, I don't know how big this is going to go. I'm just, right now, I got my thumbtacks with the strings on the wall. But like,
Don't talking about the FBI thumbtacks
yes,
with the strings
that's
on
what
there trying to
I really
connect.
felt like that's what I need to do for this show, because that's what they be having on their balance sheet. I think insurance policies. I have to Google it, but that's like something that, here, either turn my screen around. Banks and life insurance are much more connected than most people realize. It's not just the banks sell insurance products; they actually use the life insurance as a balance sheet asset. Banks own life insurance policies. Banks commonly buy bank-owned life insurance. BOLI. This means the bank takes out life insurance policy on key employees, such as executives, senior lenders, long-tenured employees. The bank is the beneficiary.
So, like, companies insuring themselves? Is that what it sounds like to me?
I mean, I don't got a problem with that, but if the insurance companies are not doing a good job at securitizing the policies, this is going to affect the banks, because this is a big part of their balance sheet. So it may not make like a run on a bank, but it affects the business of the bank. So they're not completely like.
But it definitely affects the balance sheet.
It functions like bond substitute. Banks historically held large portfolios of bonds, but bonds have problems. Interest rate volatility, mark-to-market losses. Life insurance cash value is different. It offers steady yields, no daily market repricing. So I mean, I'm not suggesting that like life insurance is like, but I know I didn't finish a full sentence there. Probably.
That reminds me of a guy I used to go to college with. One of my good friends. Him and his dad, that's what they did. They bought distressed, smaller insurance companies. Specifically life insurance companies. And then they would offshore them in unregistered territories.
Yeah, so that they can secure them with BS. Such is life. Apparently this is like started like 30 years ago. And just has gotten more and more and more and more prevalent. That's what the birdie told me.
Clearly, because this was back in 2016 when we were talking about this.
Okay, so the insurance piece is going to be a major component of this. The next component of this private credit crisis is that we have a maturity wall coming up. We have a commercial real estate maturity wall coming up.
Right.
And we have a private credit maturity wall coming up. All right. What is a maturity wall? A maturity wall is a time period when a lot of loans mature and there's going to be a turning over of money. So a lot of loans got written 2021-ish that are maturing coming up in the next year to 18 months. Okay.
Okay.
But the problem is the interest rates are not the same. So a lot of the borrowers, they can afford to pay the interest rates that they were paying. They're not going to be able to afford to refinance. So they're either going to default. We're already seeing loan terms being amended. Okay. So they're either going to default or loans are going to be extended. And that is a problem. Now, I want to also talk about like maturity terms. Another issue that is factoring into this is there is a mix match. I always want to say mismatch. There is a mix match of maturity to liquidity that is providing a huge issue. So when you invest in these funds, the average time on these loans is like 3 to 7 years. People want their money back sooner.
Okay. So question. So you know what a margin call is?
Yes, I know what a margin call is.
Okay. So essentially, is a margin call the same as a credit wall?
No. A margin call is not the same as a credit wall. A margin call is basically like, okay, hey, you have asset. We'll give you a loan based on the value of this asset. When the value of that asset drops, the underwriter, the person that gave you the loan, is saying like, ho, 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 ho. You need to either throw us some money, pay this loan off or something, because now the asset that we have that wrote the loan is going too far below our comfort level. So that's a margin call. Hey, make up the difference, run us our money, figure something out. Because this is not, and these were the terms that were agreed upon. If this falls below this value, that's the margin call.
Okay.
A maturity wall is literally a bunch of loans maturing at a certain time frame.
But both cause a liquidity crisis.
Both can cause a liquidity crisis.
Okay.
Right? Liquidity crisis because, hey, if these people can't pay their loans, the lender, these loans are not worth the value.
Right.
The borrower, what am I going to do? I can't afford this. This is going to be a problem. So it's just a problem all around, especially with interest rates this high. This is why your boy DT was trying to get interest rates down for a number of reasons. But then he turned around, cut his nose to spite his face to go to war. War always creates inflation. Oil is up over $100 a barrel. This is crazy.
Yeah.
That's going to trickle into everything. The other thing is insurance. Like, the other thing about that is maritime insurance. I think I talked about this on the last episode. Maritime insurance. We're at war. All insurance premiums are going to go up everywhere.
Premiums from the skyrocket.
Everywhere. Because
Yeah.
there's so much uncertainty.
Yeah.
The other thing I want you to understand is, so let me back up. I want to talk about a couple things that cause a crisis. The number one thing that causes a crisis, right? Like, think like the 2008 crisis that shifted everything. I think this private credit crisis is going to be the one thing that shifts this. The number one thing that starts it is this excessive amount of greed. Okay? People who are not on the front lines doing regular business, like you and me and the rest of you, the people in the ivory tower, they see what they think is an opportunity where they can quantify risk in a way that is comfortable with them legally and decide to go all in.
Right.
Private credit, let me give you an idea of the growth. It is literally a $3.5 trillion market. It has doubled in 5 years. What?
That's a lot.
That is a lot. What is that saying to me? That's saying greed, because what ends up happening, okay, they see this opportunity. Oh my goodness, private credit. We can get busy. We can underwrite. We understand what's going on. And it is so much money going in, going out. Everything is going great. Nothing crazy is messing this up. What happens is people get lax. Then there's a lack of transparency. Lack of transparency is always marked in a crisis. So a lot of these private deals that are in private funds, you don't know what's going on. Let me tell you something. An insurance company, when I talked about that insurance, reinsurance swap thing, here's the other thing. Those reinsurance companies, a lot of them are also being held offshore. And guess what? You can't find out. You
What?
can't look at those books. Even on your policy, you want to know what's backed by your policy, you can't find out.
Well, so I was just, while you're talking, because you got my brain running, I'm looking up a bunch of stuff at the same time. When it comes to those different types of backings to those premiums that you were speaking of, and then I also saw that even the even in the private credit sector, a lot of it heavily too relies on the treasury bonds or the US bonds or the mortgage bonds or like corporate bonds. So one of the things that I just saw was, says the structure of a private loan, and to get that loan rate, like the formula for that is the treasury yield plus the credit spread.
Depends on how the loan is structured. So like there's always, so basically the way the bond markets work is the treasury is usually like the gold standard. I don't know what what US treasury is rated right now, AAA. That's like, that means zero risk, because the government can print their own money.
Right.
So it's zero risk of default. It's close to zero as possible. Okay. So usually, depending on how it's negotiated, you may see where it's like, okay, what's the rate that this private loan is paying? Hey, it's treasuries plus whatever the spread is. Whatever they're saying the private credit spread is, to justify this zero loan risk, there's zero loan rates. I mean, zero rate, zero risk rate. Okay, between that and what the possibility of you defaulting on, we're going to assign a numerical value. Is usually, not usually, I don't know what it is, but could be, if it's tied to treasuries plus 3 bips, treasury plus 5, treasuries plus 10. It's probably somewhere around 10.
And so one thing that I also saw was, speaking of what you just spoke about as far as defaulting, because it said most private credit loans are on a floating rate basis.
Okay.
Floating rate loans.
To treasuries or to Fed funds?
To treasuries.
Okay.
Meaning that those interest payments
Can vary.
adjust with the rates.
Yes, and so when we have when we have inflation, they go up. Defaults. The writing's on the wall.
Yeah.
But here's the thing. I want everybody to understand this. Like, stop second guessing yourself. You started noticing a couple of years ago, more of your friends been talking about broke than they were before. Meanwhile, we go online and everybody still got to keep up with the Joneses. Let's keep it a bean. When I made that post and said, hey, I'm not having a good year in 2024, when I made that post, do you know how many people came out and was like, I'm so glad you said this. Why are y'all so scared? I don't care about these people and what they think of me. I know how to make money. And if I'm not making money right now, it's just part of the game. God is teaching me something. I got a lesson. All I got to do is sit and wait and learn and be obedient. Do it hurt? Yes. But that don't make me less of a person, because I can't pretend like everything is perfect. I was just looking at this page. I'm about to take this in a little quick tangent. I was looking at this girl that I've been following. She's a lifestyle influencer. And I meant to unfollow her, Because ain't nothing wrong with her, but I just didn't even like my response to it. Anytime I have a response to somebody's content and it's anything less than loving, why am I following you? Like, this is a me thing. It's not even a you thing.
Yeah.
But I've been following her for years. And she's got big giant house, husband, 2 kids, and she just recently made a post and was like, it said something like, God said, I'm gonna spoil her. And then it was just like this highlight reel of her life. And I thought about it and I said, you have literally never, ever, ever posted anything that was troubling to you. And so let's pretend like this is a reality, that you just had this 10-year stretch of your life being perfect. Me and you can't relate. So why am I following you?
Deep.
Like, so I'm not tripping that you did have a 10-year stretch. I would like to have a 10-year stretch of nothing going great. And I want y'all the same thing. Nicole, I don't relate to her no more because her life is perfect.
Yeah.
I would like for you to do that. But what I'm saying is, we all know that that's not true.
Yeah.
First of all, you about 10 pant sizes bigger than when I first saw you, so I know that's making you feel away. But my whole point is, nobody's judging you if you're not perfect. And so we have to have this whole idea of everything being perfect. And while everyone is pretending, we're all pretending and we're looking at ivory tower people, and guess what? They don't know anything. Because y'all down here is pretending like everything is all perfect. Meanwhile, if you just stop pretending and pull back the veil from your eyes, you literally can see your next trade. You can see it 10 steps ahead. Because these people, they don't want to come down from your ivory tower. All this stuff is underwritten on your behavior. All of it. These SPVs, all of these sexy products, reinsurance, co-insurance, the offshore accounts, all of it is based on predicting your behavior. And so you're at the front lines. I'm going to talk to y'all about how y'all can take advantage of that, but I still want to get through this explanation. I want to make sure that I have everything out before we start talking about how to take advantage of this. Okay? All right, as we're looming this crisis, I gave you a couple things that marks a crisis, and we almost got all of them. All right, first I talked about greed, then I talked about lack of transparency. Then I kind of already touched base on this, but I just want to make sure I drive this point home. Increased risk, right? Ivory Tower peeps and Epsteinians. Not all Ivory Tower peeps are Epsteinians and vice versa, but they all go together. Ivory Tower peeps and Epsteinians, they start taking on more and more and more and more risk because they get arrogant. And part of the arrogance is plagued by just the lack of understanding what's really happening. You think you can figure things out from the ivory tower, but you don't know, you don't see what's happening on the level that you and I are on the regular folks level, okay? So when you start seeing that they're making decisions that are not in line with what you are seeing, that's how you know there is an opportunity. You just got to be willing to wait. If so, like right now, I don't know how many years or if it's years out that we are between this material event. But when you do start to see it, you have to be willing to wait a couple years because people can't think in terms of like a couple years, especially when you have these big, slow moving glacial crises coming. Because I started seeing all of this all the way back in 2023, 2024. I started seeing it then. Even I struggled with acting on it at that moment. Really, honestly, I'm not going to lie. I kind of started seeing it in 2021. That's a whole nother conversation for a whole nother day. Okay. So they start taking on more and more risk. There is this lack of understanding what's really happening. They don't really understand what it is that they're underwriting at all. And we're seeing it right now. The next thing that marks a crisis, when you start seeing more public access to instruments that were usually reserved for the private markets, then you know something is happening.
For example,
these exchange traded private credit loan funds, publicly traded. Why you need to come down to the regular people? Y'all love keeping stuff out of our reach.
Yeah.
Why we here? Bitcoin, exchange traded crypto. You know that just happened last year. Why do you need to come down here? Y'all love keeping stuff from us. Why? Now I'm not saying that it can't be a solution, but what I'm saying is you need to start looking under the hood, because now we're seeing that the exchange traded crypto funds is what's causing the fall of crypto prices.
Right. Like the ETFs and stuff like that.
Right.
Yeah.
Why you need to come over here? Y'all can't solve this problem with yourself, because trust me, if y'all could solve this problem with yourself, y'all wouldn't be down here. Oh, you all of a sudden now y'all like, we're part of PayPal.
Which reminds me of what I just read, and it makes me think when you, like, as you were saying, like, why y'all gotta come down here? Because it just equated money to oxygen, right? And it's like, the higher you're up, just logically thinking and from a physics standpoint, the higher you go, the thinner the oxygen gets. But then that makes me that make me think the liquidity crisis, right? They got to dip down because the money is drying up there. The money's drying up.
That's my point.
And
Why is
so-
it drying up though?
Yeah.
There's something mispriced. Okay. But this last thing marks this private credit crisis, but also marks crisis overall, all crisis. There is always usually some sort of change of the guard or new technology.
Okay.
Okay. In this case, AI is a big driver for the private credit crisis because tech companies are relatively risky, especially knowing we don't know what AI is going to do to our economy. Guess who's taking out a lot of these private credit loans?
Tech companies.
Tech companies. You got two types of tech companies: AI tech companies and the tech companies that are so big they haven't even been able to figure out how to fully transition over to AI just yet.
Right.
That is very risky. On top of the fact that these AI companies, they're not even profitable yet. And you got a bunch of loans. I heard that it's a lot of loans in these funds in the private credit space. That's all financing tech initiatives.
Which is weird to me because, and I think you saw it too. I think we both saw it. But essentially, what it said AI is supposed to do to the economy and jobs and things like that. If you're taking out all of these loans, integrating AI, which is going to replace so many people's jobs.
So they put out a report, somebody, I can't remember who it was. They put out a report that showed, it was just a weird way the way that they graphed it, that showed how AI affected current industries versus how it's going to affect a lot of industries. And a lot of these industries, their world is going to be rocked. Then someone else took that same graph and put it into bar charts. Basically, like, let's make this very, very simple.
Right.
And the industries that AI has affected and will affect even more, white collar industries, all of that stuff. The ones that it didn't, trades. Okay? My question is, okay, as a collective, as a society, and this is where governments are supposed to step in, we as a society, we are seeing that AI is putting people out of jobs and companies are reducing their costs by integrating AI into the business. So therefore they're trying to increase their bottom line. But what difference does it make that in 5 or 10 years, not even 5 years, 2 to 5 years, you're going to have less sales because people don't have jobs.
Right.
This is crazy.
Because people don't got the money.
So if I were you, not me, y'all know I have very strong stances on how I like to place my money. And I get that most of y'all are not going to agree with me, and that's okay. This is just, Nicole just believes in Nicole more than any of this. Okay, so I'd rather place my money on me, okay? But if you are looking to take advantage of what's happening in the world, the market, right? I would be very, very, very nervous about, one, investing in the private credit space because
Mm-hmm.
they're hedging their bets on AI and we don't know what it's going to do.
Mm-hmm.
I will also be very, very nervous about hedging my bets on consumer-based AI companies.
Mm-hmm.
Because if they are relying on consumer income.
So I heard you say something earlier about distressed assets.
Yeah. Let's talk about distressed assets. Well, before we even talk about distressed assets, we did this whole conversation so that we can talk about what you can do about it.
Right.
Okay.
Mm-hmm.
So this is why we invest in apartment buildings because we have already been seeing this where, especially in Atlanta, y'all, one day we're going to do an apartment building episode where, especially in Atlanta, where these assets are being sold at pennies on the dollar because they were underwritten a while ago in 2021, 2020 at certain numbers based on illegal immigrants filling up these apartment buildings. Okay? And so now we see, and this is what they were thinking, right? This is why they were doing so many loans. Okay, then now things are being repriced.
Right.
People are struggling with keeping these places occupied. Things aren't mapping out the way that they're mapping out. And here we are, everything's getting repriced at pennies on a dollar. So going after distressed multifamily assets, knowing that we have a housing crisis, affordability crisis, invest with your girl. Okay, this is why we do. One thing I love about this show is a lot of times, especially in finance and macroeconomics, I will see what's happening, and then when you're doing a pitch, you're relegated to, I don't know, 30 minutes to explaining your thesis. And guess what? Investors, especially accredited investors, they're getting pitched all the time, and so you have to sell them on your thesis. And the good thing about this show is my theses are never just like, oh, I see this and it's, y'all see how my brain thinks. I'm always 25 steps ahead. I get to explain this, and I'm not saying this because I'm trying to convince you to invest in a fund. Yes, I am. That is my job. But I'm saying this because I love the fact that I get to really explain, like, okay, I didn't just wake up and say I want to do apartment buildings. And I don't want you to just wake up and say you want to do this. I need you to map it out. So whereas though, based on your standards, whatever you do is a risk-free trade. This is a risk-free trade to me in my mind. Investing in apartment buildings. We got a housing crisis. There is a distressed asset problem. Y'all go, when these loans, these commercial and private credit loans come maturing and y'all can't refinance, you gotta sell. And you gotta sell at pennies on the dollar.
So when you say pennies on a dollar, because we were talking off camera earlier, and you were talking about buying debts and things like that.
Okay, so here's the other thing. The other way that you can take advantage of this, right? So apartment buildings and or my fund. Easy, okay? The other way you can take advantage of this is an idea that I have. If I had more time, y'all, I would do this. I was just saying to Brandon, I'm thinking about figuring out how to cut out some of this stuff that I'm doing and focus on this, all right? So Ivory Tower peeps, Ivory Tower and the Epsteinians, they don't know how to really, so like a crisis happens because they don't really know how to underwrite. They think they know how to underwrite, but they don't know how to underwrite.
Right.
They don't know how to underwrite these private loans, okay? And we may be thinking about private loans to do $1 million buyouts, $1 billion buyouts. No, but it's also small business loans and even buyouts of small businesses, small and local businesses. And this is why I keep telling y'all, because they don't know what's going on, it makes it seem like everything is crazy. But when you understand your local market, because you live there and you see what's going on and you got your thinking cap on, you understand your local market. They can never understand your local market like you can. And that's where that's where the money is. Okay. So if private credit is drying up, and we know we got all these baby boomers that's selling all of these businesses, laundromats, HVAC businesses, plumbing businesses, all of these family-owned businesses. Private credit's drying up. Baby boomers are selling these businesses. Millennials, what are you, Gen X? What is that?
Millennial.
Oh, you're a
I'm
millennial. You a young millennial.
Yeah, no.
You a true millennial?
I'm a true
I'm
millennial.
an old millennial.
Yeah, well, I'm a true millennial.
Okay, what's that next generation under you?
Gen Z.
Gen Z. Okay.
Yeah.
Gen X is okay. So you got millennials, Gen Zs that need to buy them. Guess what? They're not going to be able to get the credit. They're not going to be able to get the credit to do it. So my idea is to start a fund, small fund, 10 million, you go down to 1 million. A small fund, pick a niche that you understand like nobody's business, or find someone who understands a niche like nobody's business. Okay? Your cousin owns an HVAC business, or your cousin is the bookkeeper. She's been the admin lady for the HVAC business for forever. She know everything. She's just not out there doing all the stuff. Partner together. Raise some money within your friends and family. Now you got to make sure the person that understands this very niche business really knows their stuff. Start doing private loans to HVAC businesses. That's it. You only do HVAC business loans in Savannah, Georgia. That's it. You only do cleaners business loans in Tuskegee. That's it. You only do, I don't know. Think of, like, I don't know why my brain is freezing on. Like, you only do restaurant loans. You gotta know somebody that understands restaurants.
And the benefit of that would be?
The benefit is loans are still needed. Ivory Tower don't know how to write this because they don't understand the industry. They don't know what's going on. I could have told y'all that real estate was going to be an issue 2 years ago, but nobody came and talked to me.
They just writing BS loans.
They're just writing loans because y'all don't know, but I'm on the front lines. Not only am I on the front lines, but I have a real estate club. I'm seeing what everybody is going through. I did a show. Shout out, y'all was watching the show. I had the, first I call it the, I can't remember what I call it, but I had a show where I was just talking about real estate news. Shout out to y'all who was watching me. This is 2023. Matt, MG the mortgage guy, was taking my show and putting it on his platform as well. Shout out to Matt. Some of y'all was paying attention. You know who was paying attention to me? Welby. I don't know if you know Welby. Huge real estate influencer. He up. I'm not taking credit for Welby being up. He's been in the game for 20-something years.
Yeah.
But what I'm saying is, you know this stuff. People are going to need loans. The credit market is drying up. A good business that will probably still do well if they pay attention is like hard money loans. A lot of hard money lenders are hyper local. Not all of them. Some of them are national, and I tip my hat to them. But the hyper local ones, like this one lender that I used to work with, they are investors in the market. They understand them. They know what's going on.
So are you saying essentially on that level, right, on that private level, that those loans that can be written can outbeat?
They can outperform all of it because you know what's going on. So you're going to have to educate yourself in a couple of things. First of all, we're going to assume you really know this asset. Don't do it if you don't know this asset class or this niche. You don't understand this business, because what's going to happen, let's say you partner with your cousin Rashad, okay, make up a name, Jamar, okay. Let's say Jamar's had an HVAC business for years, and we already know Jamar is super smart and he knows what's going on at HVAC in the city. He understands also how to run the business, not just what's going on. He understands how to run the business. Okay, so you and Jamar, you say, hey, we're going to do HVAC businesses in, let's say, I can't think of anything other than Philly because I'm from Philly. We're going to only lend to HVAC businesses in Philly, Jersey, Delaware. We know what's going on there. When you go to underwrite, because remember, this HVAC business, they're not going to be able to get private credit in 18 months. They're not going to be able to really get business loans. Their hands is going to be tied. But guess what? These are the industries, and I forgot this part. these are the industries that on that AI chart that's affected, those are the ones that's not affected. The labor businesses. How did I forget to say this? This was my whole thesis. Remember, I was like, I got an idea. I want to do it. Those are the businesses that's not going to be affected. But guess what? They're not going to be able to get the loans. Right. So you go, say Jamar. All right, Jamar knows HVAC. But again, most importantly, he understands the business side. So when you go to make these loans, you're going to do an extensive underwriting process. And when Jamar asks for the documents, P&L statement, balance sheet, everything. Jamar know, hey, what's your processes? Let me see whatever your processes and your procedures are. You're going to have to see what's legal and what you can ask for if you're doing a loan. But it's on the private side, you could probably ask for everything. You're looking under the hood of the business. Guess what? Jamar knows how to look for it. So now, I don't got the same problem as them. Hey, yeah, we'll give you a loan, a 5-year loan at this, and you're going to be paying 15% interest.
I see where you're going now.
Right. You're going to be paying 18% interest. Because guess what? Credit card's about to get shut down too. But you got to know the industry, and you got to understand the business side of the industry too.
And you got to understand how to underwrite.
You got to understand, because that's what the Epsteinians and the ivory towers, that's what they don't understand, the business of these niche businesses. Right? Y'all writing loans on AI tech businesses. Y'all don't understand this stuff. They don't even understand this stuff. We don't know what's going to happen. We don't know how the money is going to go. What are you doing? And y'all just giving out loans willy-nilly in your suits and your Rolexes. I ain't got no problem with suits and Rolex. You got a suit and a Rolex. Email me. No, I'm joking. I ain't got no problem with suits and Rolexes, but like y'all sitting up there like y'all know and y'all don't know. Legit. This is what happened in 2008. Nobody wanted to get off their ivory tower. Get out your ivory tower. And remember I said this probably on one of the very first episodes. You are an insider in something. Figure it out. I think I'm done. I think I literally covered everything here.
So, I'm about to ask you a question. So,
That's cool.
Essentially, the Epsteinians, now I got to use that word.
Epsteinians and the ivory towers.
The Epsteinians and the ivory towers are writing these loans, underwriting these loans on unrealized future events. Basically just prediction.
For insurance. For the insurance, because insurance is regulated by a different entity on a state level. They have these states that are allowed for permitted practices. These permitted practices allow them to basically do cloak and dagger behind what's backing the asset. You couldn't do it in another industry. You can only do it in these permitted states are Vermont, Iowa, South Carolina, and I can't remember the other two. It's 5 of them. In these permitted states, they allow you to basically provide a cloak around what you can back them with.
And when you say insurance, you're speaking specifically on
insurance
premiums.
No, insurance companies, yeah. So usually the premium is, so people pay a premium, pay into it, but you have to pay a death benefit. The death benefit has to be backed by assets. Like, oh, yeah, you're paying a premium, but it's $5 million. Where are we getting the $5 million? You got to have something over here worth $5 million to pay it.
Right. And you're saying that those assets that are backing those policies,
because private equity came in and started getting real risky. It wasn't ran by it wasn't owned by private equity before. It was owned by majority nonprofit organizations that was like, we're going to buy some treasuries. We're going to buy some, I don't know, something super safe.
Right.
Then private equity got in. This is why I say capitalism does not work on large scale. Once you get too big to fail. Now y'all got $300 billion. I'm just using that number as an example. $300 billion, and this insurance company has got to win is a problem. Now that I feel like I need to get some pins and
Now my mind is just all over the place
I
now.
need to get some pins and strings over here just so I can show you. This is going to.
My mind is in a whole different place now.
I know you wasn't expecting it.
Where are the chickens coming from? That was just like.
Oh yeah, they admit that the chickens is made in labs.
Yeah.
Yeah, don't eat that.
And it's just like, wait, what? But then it's essentially like you said earlier in the beginning of it, like it's killing you the food. It's the war. The war is here. But
because guess what? The same private equity that owned the insurance company also owned it. That's what
you can't outlive the policy, or it's a problem.
So look, right? Andrew Huberman, you know who that is? He got in trouble recently, but like he went viral a couple years ago because he's like a longevity guy, and he used to, I think he's a doctor, and he, in the process when they underwrite you for life insurance, they send, he was like maybe an actuary type of person, I can't remember. They get all this data and they send it to him, and he has to make some predictions. They can nail it down to the month of when you're going to die. And he was like, I would get these cases and I would see that if they make this one small change, they can extend their life, but I can't reach out to them and tell them. It would be small stuff like, eat this kind of salt. It's a couple of supplements that it's like 5 very simple supplements that he says that you can do. That's like everyday easy stuff to extend your life by however much. So it will be really small things that he could see, like, I would love to reach out to this person, but I can't. I'm gonna get in trouble. And so what he did was, as his way, he said, as his way of like serving, giving back. This is why he started this whole movement about the longevity stuff. Now he recently got in trouble. I did not go down a rabbit hole because I didn't really care. It was just gossip to me. But he recently got in trouble because I think he got exposed for like having a whole bunch of girlfriends and all that stuff.
Dang. Got caught up in the scandal. That's what happened when them dudes get that money. They be caught up in them scandals.
Ciao.